You're listening to the #1 spot for markets and trading, Market Traders TV. Learn some shit.
Most important thing in trading, in my opinion, and I think in most traders' opinion, is looking at risk. Is trying to understand, is the trade I'm gonna enter, how much do I lose if I make the wrong trade? If it's the correct trade, I am fine, I make money. But how much do I lose if it's the wrong trade? Because in trading, especially if you are new, you will be making more wrong trades than right trades when you're first starting. Okay, so you got to understand what your risk is. Most people look at a risk. I personally look at risk from 0.1% to 1%. What that means is whenever I'm entering a position, whether it be a long position or a short position, I try to understand where I will have my stop loss first. So let's just do it step by step. Okay, let's just use this as the level. Let's say I want to take a long here, right? It's the level to hold. I want to take a long here. What I will do in this risk is, because throughout this level, this is the previous high. Okay, this right here is the previous high. Throughout this range, this was resistance, and this happens a lot in any market. Resistance tends to become support. It is a level where people thought, okay, this is where I'm going to sell. If we achieve above it, what tends to happen in the other side is people will use it as a level to buy. A resistance becomes support, and support becomes resistance if achieved. Now, let's do this as an example, hypothetical here. Just looking at risk. Would you actually take this trade? Probably not. But let's look at it in terms of hypothetically.
We actually have that trade on the stream.
Oh okay. Anyway, the reasoning behind, I personally wouldn't, because it's a nice little liquidity pop around these levels. So most likely we will dump to these levels if we do, and then do a little pop to the top side, like we did the same thing here. There's a lot of liquidity around these levels. There's a lot of stop losses to be hit, so it's a liquidity pop, then a drop, and then the same thing to the other side as well. It just makes sense because there's a lot of liquidations here. Anyway, let's continue on. Let's say I have made a decision to go long here because of multiple reasons, and I have made a decision to take a stop loss here, right? I have made that first, and then I know what my risk is going to be, okay? Because I know that, because that is the risk I will always take when I'm taking a trade, and use this, let's say, as a 1% risk. So what that basically means is you have a portfolio of a certain amount. Now, when it comes down to this level, you are going long on it. You are buying into it, and you use this as risk. What this means is, if this trade does not work out, if you actually get stopped out or you exit the trade because of a stop loss, you will actually lose 1% of your whole account. Okay, 1% and 2% are the little golden percentages that most people use, because you can make a mistakes 50, 60 times before you lose 50, 60% of your account. Obviously, you will actually lose much more than that overall because of compounding, but still the basic picture is you can make much more mistakes and not blow your account by taking limited risk. Okay, and this is the most important thing in trading. It's not about how much money you're going to make out of it. When you're trading, as in entering a trade, the most important thing in your mind should be, where is my stop loss? What is my risk? And if that stop loss gets hit, how much do I lose? And if you have that figured out, then you start looking to the top side. Then you start looking at, okay, what is my target? What do I want price to achieve? What do I want price to pump to? What level should it go to? So your first train of thought should be always about risk, because that is where the big money is. That, in the long term, is how you're going to make consistent gains. Otherwise, you're going to be one of those one-hit wonders that you make a lot of money one day and you lose 60-70% of it the next day. You don't want that. You want to have consistent earnings on your trades. You want to be consistent. You want to be compounding. Right? And this, understanding risk, is the most important part of trading. And this is where discipline comes into play. Right? Sometimes, most of the times, your stop loss might not be this close. It might be pretty wide. Right? And price might come down all the way to here. But you know, if you get stopped out, you only lose still 1%. Do you make a decision just to close this trade where it's at right now? You have not been stopped out yet. Do you want to close it? No. Because this is where discipline comes into play. You have made a decision before entering the trade to have a stop loss here because of reasons. Because of logical reasons that you have thought through TA and basic understanding of TA. Just because price has done something unexpected, you do not want to do what is called FOMO, right? Because this is a FOMO method. What you have done here is you have a fear that this trade will get stopped out. Just because you have that fear, you have that emotional tick in the back of your head, you have stopped this trade in its track. What it could be is we could have gone really close to it and not been stopped out, and it could have pumped. You don't know. You don't know anymore. You don't know your trade was valid or not. Right? And that is a no-no in trading. You should always follow your plan because you have made a decision beforehand, looking at many things. And in this slight time, you have made a decision to close it. Why? Because you got that little tick in the back of your head going, yeah, I might be wrong, right? What makes you think you are wrong? This is the emotional side of trading. And this, to help with this, you got to have an understanding of trades, an understanding of markets, understanding of levels. And this is where you get your skill and experience from. Right? So, for the last half an hour, you have been searching levels and searching trades, and then in the last 10 seconds, you made a decision to close it. That is an impulsive decision. You should not be making that sort of impulsive decision. That is fear, and that should not exist in trading. You should leave the trade. If you get stopped out, you get stopped out. You have already understood what your risk is. You have already understood and realized that if you get stopped out, you lose 1%, and you have taken that in the chin. Why will you change? Why should you change? Because the next time, do you know what's going to happen the next time? Right? It's not about one trade or two trades. It's about thousands, it's about hundreds of thousands. What's going to happen next time is this trade is going to pop in your head, and you're going to be like, yeah, I closed the trade here, actually pumped. So what am I going to do this time is I'm going to have a wider stop loss. I will change my risk. That will happen. That will happen to you. And it is a thing that will happen.
I love Rock's comment,
right?
Responding to what you're saying. For the most part, learning to trade, I find that it's about learning about yourself and how you react to the market. And I agree 100%. Exactly what Skinner's saying here.
But
The market's
Skinner,
going to give you opportunities. It's really what you do with them.
Yeah.
What's up,
Right?
Turner?
So when you're doing, this is all obviously hypothetical. I'm personally not going to take a trade here. I know we are in the stream. The reason behind me not taking a trade here is the same thing. I wasn't going to do any shorts above 45 because this is all a liquidity zone. Any other zone I would have shorted would be 51 and 52. We didn't quite get to 52, but we got to 51. The reasoning behind it is because that's a little bit more advanced, but what it is when it comes to price action and when it comes to markets, especially leveraged markets and especially BitMEX, right? Especially leveraged markets, there is points, there is spaces in the chart where liquidations happen. What a liquidation is if you get liquidated on a short, you are buying into the market. You are buying. If you get liquidated on a long, you are selling, right? So the market will force you, by liquidating you, to take the opposite trade. So those levels is the levels where you get what we call slippage, right? That's why when you're looking at and understanding levels, you have to take that into account, especially in leveraged markets. You have to think, where do people have their stop losses? Where do people have liquidation points? And in BitMEX, it's normally a 1% or a 2% move. Where do people have those liquidations? Where is the liquidity at? Right? And that's what you use to enter your positions. You don't have your stop loss where the liquidity is. You actually have your entry where the liquidity is. What have you just done then? By just changing that mentality, what have you just done then is this. You have made a decision to buy into liquidations. And if enough people have bought into liquidations, what tends to happen is you get a reversal. Why? Why do you get a reversal if you get buys into liquidations? Because the only thing pushing a market up or pushing the market down is liquidation. And liquidation happen in market price. So it will chase the price up. It will chase the price down. Thus, if you buy at liquidation and sell at liquidation, the probability in math, the probability is you are selling top and you are buying bottom, depending on where you are in price action. Generally, okay? There is no 100% in trading. This is all math and possibility. But that is the way to trade. You look at liquidity and you take a trade there. That is what I do every single day. All right. That is what I do every single day. Sorry, just drinking water. So you look at those things. Whenever I'm talking about trading, I do get a little bit passionate. So I do get talk a lot about it. So it is a thing that you want to take into your mind. But that's, like I said, that's just a little bit more advanced. But it is a thing that is out there. So you have now understood what risk is, and you have understood why you should take that into account rather than looking at reward. You should always have risk in mind before acknowledging reward. Stop loss should always be in. And when you take a trade, whatever trade you're doing, you should always have a stop loss. Try to limit that risk. Why lose 2% when you can lose 1%? Because just in case the trade doesn't work out, right? There is limitations in your risk, and you take that into account, whatever you're trading, all right? And if you take that into account long enough, you will get to a point where even if you are successful 50% of the time, even 40% of the time in trades, you will actually be successful and profitable over time because you have taken risk into account. If you take 1% risk and 4% reward in every single trade, you can be incorrect 40% of the time and be heavily, because the only thing you're going to lose on those trades is going to be 1%. But remember, you have made 4% in each trades. So trades is about risk. It's not about how much correct trades you do. It is about risk.
You're listening to the #1 spot for markets and trading, Market Traders TV. Learn some shit.